So how policy loans work. This is really the key to understanding the whole idea of the infinite banking concept and really making it transparent, because there's a lot of misconceptions or ideas out there that when we borrow, we pay the interest back to ourselves, or that we can always borrow off the death benefit. What we want to know is when we borrow from a policy, what's the impact to us as the policyholder and also to the insurance company? If we understand how they're making money, it'll help us understand the concept further as well. So we've got a pretty simple example up here, a 45-year-old male. This is one of the major mutual companies we're going to look at. We're going to look at two comparisons. They're the same policy. The first one's a high cash value life insurance policy account where an individual pays in $50,000 a year for 10 years, compared to the exact same policy of the same individual paying in the same amount of money for the same period of time. The difference, in one example, we're going to see what he pays in. We've got his break-even point, year 4. This is a non-MEC, by the way. Pays it in for 10 years, nothing in thereafter, lets it sit and grow. We've got the dividend column as well. Compared to the example where we decide to pull loans out. So when it comes to loans, we can take out loans from a life insurance account anytime we want. No penalties, nothing like that. So we're going to take out a loan, year 5 in this example, of $200,000. So we pull out $200,000. The first thing that I want to highlight here is when you look at the death benefit at this point in time, this is year 5, 1.428, $1,428,000. Compare that to the same point in time when we just let the money sit and grow, $1.6 million. It's an exact $200,000 reduction. So we've got your loan balance there. Now in this example, he decided to repay it like clockwork, right? $50,000 a year. The loan interest on this example was at 5%. Right, so if we actually tally up those repayments, here's the important thing to note, is we took out $200,000, we see the reduction in cash value, view that really as your line of credit, that's what that is. We paid back $228,000, call it $229 if we want to round up. So that extra $29,000, that was interest that was paid to the insurance company. It did not go back to ourselves. So if we were to stop there, this concept, the whole idea of using a life insurance policy as a financing vehicle would make zero sense whatsoever. Where it makes sense is if we look at, let's just look at year 10 where it's paid back in this example. Hypothetically, he paid it back aggressively, but there's going to be something consistent here. When it's repaid in year 10, our cash value is $570K and our death benefit's $1.9 million. The example where we just let it sit and grow, our cash value is $570K, our death benefit is $1.9 million. Your values are 100% restored to exactly what they would have been if we had never pulled it out in the first place. And that's going to be the case if we pay it back like clockwork, very aggressively, or if it took us 70 years. It doesn't matter. The main takeaway is anytime we take out a loan from a life insurance policy and we pay it back, whether it takes us a year, 10 years, or 30 years, whenever, when the loan's repaid, you'll see your cash value and death benefit fully restored to exactly what it would have been if you had never pulled out a loan in the first place. How that works is they hold our death benefit as collateral, and while they do that, they pay the same dividends out as if we never pulled it out in the first place. There are some differences with non-direct and direct recognition. If you're sticking with the major mutual companies, the quality carriers, doesn't make a whole lot of difference. It's usually used for marketing. That's where the back and forth is. But you will see a consistency regardless of the type of company. Dividends are paid on everything, whether it's all in cash or if we've borrowed some or all of it out. Hope this helps.